Hello, good morning to all. I hope that you all have a great weekend and welcome today for today's daily dose of market insights by OANDA, a brand new trading month ahead, and today will be the 4th of December. Very good morning. I'm Kelvin Wong here, the senior market analyst of OANDA Asia Pacific. So before we start our usual daily dose of market insights, let's take a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product. All right. And as well as any forecast, prediction, or projection in this documentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now here we go. So before we start our daily dose of market insights, let me share with you all what happened over the weekend, that means i.e. Friday and over Saturday. So firstly, right, what we could see over here is on last Friday during the US session is more of a risk on session. Why? Because the longer term US Treasury yield going to inch downwards, that means lower cost of funding, reduces the equity risk premium, which actually starts to actually reinforce this traditional bullish seasonality for US equity market. So if you look at the heat map of the S&P 500, almost all component stocks are in the green, with the acceptance for the server, I would say 1, 2, 3, 4, yeah, 4 mega cap US stocks, which is primarily the tech and growth stocks, Microsoft, Google, Meta, and Tesla, underperform the overall market. But net, if you look at the performance over here, we could see the SPX still have a positive return of 0.6%. The underperformer will be the Nasdaq 100. Why? Because of the underperformance of the 5 mega cap stocks with the likes of Apple, Microsoft, Meta, and as well as Tesla, but still managed to close positive 0.31%. The Dow Jones Industrial Average actually outperformed 0.8%, followed by the Russell 2000, which is have a gain of positive 3% due to this continuation downside pressure of the US 10-year Treasury yield. So if you look at the technicals of the US 10-year Treasury yield over here, overall, what we could see on last Friday is that prices going to inch lower, and actually this is the lowest close since September 2023. And technically speaking over here, it seems to us that potentially there could still be more further potential downside before testing the 200-day key moving average, and as well as confluence with this keys long-term circular pivotal support zone of 4.06%/3.97%. Okay, then also if you look at the US dollar overall, also continue to remain weak as well. So with the weakening of the US dollar over here, it starts to actually continue to actually inch downwards below the 200-day moving average. So that actually also kind of put a bit of reinforce of that ongoing medium-term bullish trend in gold price, spot gold. So later I'll touch on the chart of spot gold. So as we speak, early today, early Asia session, it actually pierced to a fresh all-time high at the 2100 figure level. So if recall, the all-time high in gold was 2075. So in today early Asia session, it managed to breach past this level. So potentially, what will be the technical analysis bias next? So later I'll share during the short-term daily outlook for gold in a while time. Okay, so some other key events to actually reinforce this weakness in this longer-term US Treasury yield is due to the fact that there is another key US economic indicator that indicate to us that there is an increasing chance of a potential recession coming into US in 2024. So what that does mean? That means that an increase in expectation of a Fed funds rate cut heading into 2024. So what is the key economic data that suggests this is the ISM Manufacturing Index, all right, PMI, okay, ISM PMI Index. So the manufacturing PMI Index was actually unchanged at 46.7 in November, in line with October, but it came below forecast of 47.6. So any number that is below 50 over here, indicating to us that the US economy, manufacturing activity is still in a soft patch over here. All right, then also one of the subcomponent also remains rather weak over here is that the production moved to a contractionary level from 48.5 to 50.4, and as well as the, give me a minute, I think there is something around. Yes, so this is another key subcomponent that's a turn weak. So overall, right, what you could see over here is that market now starts to actually price in an increased expectation of a Fed pivot from hawkish to dovish. So this despite the fact that US Federal Reserve Fed Chair Powell has a public speech on late last Friday, indicating to us that he actually hasn't actually think of any potential rate cut yet, and he said policy is well into restrictive territory. And also he gave a hint that the central bank is prepared to tighten further if needed. All right, so this particular his speech over here, it seems to he wants to actually dial back on this increasing dovish expectation that is being portrayed by market participants towards the Federal Reserve mandate right now. So but very interesting over here is that market continue to ignore Fed Chair Powell latest Friday speech. So if you look at the CME Fed Fund calculation, Fed Fund 2 calculator based on Fed Fund futures pricing, so very low chance of another hike coming into the 13th of December 2003 meeting. So that's about 2 weeks from now. So just only 2.3% chance. So the bulk of it still expecting no change. That means, i.e., the current interest rate hike cycle that started about 1.5 years ago, this current rate at 5.25% and 5.5% is very likely will be the terminal rate as being priced by the Fed Fund futures market. And what is the expectation pricing like going forward into 2024? So this is the accumulated probability chart that I share with you all in the, I mean, those who actually follow in my daily market, those I've been sharing this chart. Why is it important? Because it's the Fed Fund futures expectation, market expectation heading into the future. So if you look at heading into the future over here, there is actually less than 5% chance of a hike going into 2020, the entire of 2024. And what's the market actually looking right now is so dovish that the first interest rate cut close to 60% will come in as early as March next year. So the higher probability will be in May and June. And what we could see over here is, given the fact that right now it's at 5.25% and 5.5%, if you look at the one that is shaded in light blue, we start to see a chance of 1, 2, 3, 4, 5. 5 potential interest rate cut coming into 2024. So that's close to about 1.25% basis point off the current rate right now. So that is what I call a kind of a much more ultra dovish expectation that being priced by market participants. All right, so what you could see over here is pardon me, okay, I think there is something wrong with the, I'm not sure whether the voice is working, but let me check right now. All right, let me do a check. Mic test 1 2 3. Okay, I think it's working, still working fine. Okay, so basically what market is expecting right now is a kind of a rather ultra dovish pivot heading into 2024. So it's all very important on the 13th of December FOMC meeting. Why? Because that day itself, the Fed will also release its latest dot plot. So this dot plot will actually comprises of Federal Reserve official median forecast on interest rate, the Fed fund rates, inflation, and as well as economic growth. So something to pay attention to, but nevertheless, the current market pricing is still ultra dovish, which actually fit on into this risk on behavior in the US equity market. Okay, now with that, let us kickstart the short-term technical outlook. So let's start with the benchmark, global benchmark indices first. All right. So with that, let me expand my screen so that you guys can see the screen instead over here. So let's now start with the Dow Jones Industrial Average first, the US Wall Street 30. So over here, the US Wall Street 30 over here, what we could see over here is that the market going to inch up higher and hit the resistance level that we mentioned on Friday, 36,240. RSI, yes, is overbought level, but there is no clear signs of a bearish divergence. So lower low, so it's similar, lower high. So this is a similar high, higher high. So what you could see over here is that potentially there could be a minor pullback given that the RSI now is at the overbought level. So I will actually tighten my key short-term pivotal support for today, close to last Friday's swing low at 35,930. So still maintaining that short-term bullish outlook with the next intermediate resistance coming in at 36,555. However, if you see an hourly close below 35,930, then this short-term bullish outlook will be negated to potentially kickstart a minor corrective rebound to say what we call a pullback or retracement back towards the lower limit of this minor ascending channel from 10th of November, now acting as a support level, also confluence with the minor congestion area of 29th of November, then 30th of November at 35,490. Okay, Nasdaq 100. So over at the Nasdaq 100 over here, what I could see, the Nasdaq 100 was actually the underperformer last Friday due to the underperformance of Meta and Microsoft. So it kind of going to trade sideways below the near-term resistance of 16,160 for the entire of last week, but still holding above the 20-day moving average, which now confluence with our key short-term pivotal support level at 15,690. So still no change using 15,690 on Nasdaq 100 to maintain that short-term bullish outlook. Clearance above 16,110 will kind of reinforce that bullish, we call it momentum, with the next intermediate resistance to watch will be at 16,310. Okay, only an hourly close below 15,690 will invalidate this short-term bullish outlook to see a minor corrective decline or retracement to retest the next support level, next intermediate support level at 15,310 / 15,165, which is also confluence with the 50-day moving average acting as a support level. Okay, now that's for the major US indices. European indices, German 30. So the German 30 going to inch upwards higher and higher. No clear signs of a bullish exhaustion as indicated by the hourly RSI. Hourly RSI going to slope upwards in line with the price action, but now it's actually hovering at the overbought level and attempting to exit from it. So all in all, right, there could be a minor pullback coming into place. So I will use a Titan key short-term pivotal support level, which confluence with the median line, the dotted median line of this minor ascending channel that is in place since 27 October low, and also confluence with last Friday's swing low area as well during the European session. Minor swing low area 16,275 will be our Titan key short-term pivotal support for today, still maintaining that short-term bullish outlook. Intermediate resistance 16,500 followed by 16,560. So what 16,560 is actually the upper boundary of this minor ascending channel that is in place since 27th of October low. But however, if we start to see an hourly close below 16,275, then this short-term bullish outlook will be negated to potentially kickstart a minor corrective pullback to see a retracement to retrace down back towards the lower limit of this minor ascending channel, confluence with this support zone area, which is the former minor swing high of last 24th of November, 2 Fridays ago, 16,110 / 16,050. Okay, so that's the outlook for the German 30. Now moving on, next will be the Asia indices. So for the Asia indices remains weak, especially on the Hong Kong 33 index. So for the Hong Kong 33 index, no change. We tidy up our short-term pivotal resistance a bit at 17,140, which is close to last week's swing high, last Thursday and last Friday's swing high area. Still looking for that short-term bearish outlook to retest the major resistance zone of 16,640 / major support zone, pardon me, 16,640 / 16,500. Only an hourly close below 16,140 will start to kickstart a kind of a minor counter trend rebound to test the next intermediate support level at 17,380 / 17,540, which is the minor which is the former minor ascending range support from the 24th of October low, now turns into pullback resistance, with so confluence with this downward 50-day moving average and 20-day moving average acting as a resistance at this similar zone as well as 17,380 / 17,540. So still maintaining that short-term bearish outlook on the Hong Kong 33 as long as 17,140 short-term pivotal resistance is not surpassed. Okay, so that sum ups for the indices. So let's immediately jump on to the FX. So for FX over here, European currency, euro dollar, continue to trade within our range. So last Friday, it going to inch down much lower during the start of US session before managing to stage a bounce at the 20-day and the 20-day and the 200-day moving average, which corresponding to this minor range, a minor swing low of 16th of November and 17th of November at 1.083. So with that, still no change, still maintaining that neutrality outlook sideways between 1.083 and 1.092. Only an hourly close above 1.092 potentially could reinstate that short-term bullish tone with the next intermediate resistance coming in at 110.40. Okay, so still maintain that neutrality sideways, we call it range for the range view for the euro dollar between 1.092 and 1.083. Sterling dollar managed to perform better than the euro dollar, going to inch upwards and managed to shape a higher low right now during the Asia session. So this will be kind of like a near-term pullback support level at around 1.02670, but I want not to use it so tight at this is my key short-term pivotal support level. So still using that 126 figure as my key short-term pivotal support level to maintain that short-term bullish outlook for the sterling dollar, with the next intermediate resistance coming in at 128 figure after a clearance of last week high at 127.20. All right, so still maintaining that short-term bullish outlook on the sterling dollar. But however, if we start to see a breakdown with an hourly close below 126 figure level, then this short-term bullish outlook will be negated to potentially kickstart a minor corrective pullback or a retracement towards 125.20 / 124.40 support zone, which also confluence with the upward sloping 20-day moving average and the 200-day moving average as well. Okay, next will be the Aussie dollar. So Aussie dollar continue to inch upwards within our expectations since last week. So right now it's about to test that 67.10 resistance level. So potentially it may start to see a bit of pullback first, given that the RSI now managed to exit from the overbought zone. But no signs of a kind of a bearish, bullish exhaustion. Why? Because the RSI don't have any bearish divergence. So potentially a pullback. Near-term support will be at 66.30 level, but I will not use this as my key short-term pivotal support level for too tight. So I was still maintaining last Friday level at 65.95. So this is a pretty much crucial level because it's confluence with much more key elements, which is the swing low area of last Thursday, as well as the 20-day moving average that has been taken out and retest on last Friday as well. Okay, so 65.95 key short-term pivotal support level, maintaining that short-term bullish outlook on the Aussie dollar. 67.10 breakout, next resistance will be at 67.45 in the short term. However, an hourly close below 65.95 that will negate this short-term bullish outlook to kickstart a minor corrective pullback or retracement back towards the this former minor range resistance now turns into a pullback support at 65.20 / 65 figure, also confluence with the 20-day moving average, upward sloping moving average as well at 65.20 / 65 figure. Okay, now moving on will be the dollar yen. So dollar yen going to remains weak over here. So if you look at the dollar yen chart right now in today Asia session, negative follow through after last Friday, we call it bearish price action that actually broke below the last two candle close over here, and right now during the Asia session in time to inch much lower, and now it's actually breaking down below this medium term ascending channel support since the low of 24th of March. So next big support level to watch will be at this 145.80 level. Okay, 145.80, pardon me, not 144.80 level, 144.80 level, which is the former swing high of 30th of June. That was actually being supported during the 1st of September and 24th of August this year after that 2 times of a retest from it. So this will be the next support level to watch. Okay, 144.80. So if you look at the short-term technical outlook on the dollar yen on the hourly chart, last Friday we will return neutral. So it broke below the neutrality level, which was last Wednesday low breakdown. So all in all, right now potentially, right, the next support level will be at the 144.95/144.80, but highlight on the daily chart. So right now, it's already tested the first short-term support zone at 14620/14590 next. So RSI is now at the oversold level potentially. So potentially there could be a near-term, we call it a near-term counter trend bounce. Okay, heading towards this zone level over here, which is at 14625, 14760. So graphically, it's a congestion zone, you could see formally. And if you do the Fibo retracement from the last Friday sell-off, it's at the 50% and the 61.8%. So I will not use this zone here as my Titan key short-term pivotal resistance. Instead, I will use last week high, which is last Thursday high, 148.850, which also correspond to this minor descending channel that is in place since 13th of November, indicating to us that this short-term downtrend still intact. Now confluence with now acting as a resistance at 148.50. So as long as 148.50 holds in any potential corrective bounce, we call it counter trend bounce, potentially the dollar yen could still see further potential weakness with the next intermediate support level. After 145.90 breaks will be at 144.90/144.80 level. All right. But however, if we start to see an hourly close above 148.50, then the short-term bullish outlook will be kind of damaged to see an extension of this minor corrective rebound heading back up towards the 50 and the 20-day moving average, acting as a resistance and so confluence with the minor swing high area of 23rd of November and 24th of November at 149.70. Okay, so flipping back to a short-term bearish outlook on the dollar yen below 148.50 short-term pivotal resistance. Okay, now very quickly, gold. Okay, so for gold price over here, if you look at the current gold price, what we could see over here, okay, give me a minute. Okay, short-term gold price over here broke above the 2075 key over here, 2075. So that is the current all-time high level. So you look at the daily chart, right? The daily chart for gold. Okay, this is the day chart for gold XAU/USD. So right now it already broke above the 2075 all-time high in today's Asia session. So current all-time high print over here will be at 2149. Okay, 2149 is the current all-time high print intraday. But what you could see over here is that there is a bit of overstretch right now, and it start to show a daily potential shooting star. So what we could see on the hourly chart over here is it also hit the upper limit of this short-term ascending channel that is in place since 6th of October low. So indicating to us right now is potentially we could start to kickstart a minor corrective pullback within this short-term uptrend that is still intact. So as long as 2152 close to today's high, which is a Fibo congestion extension zone, 2152 short-term pivotal support hold, potentially right now gold could be in the midst of a minor corrective pullback or a minor, we call it minor counter trend decline towards 2067. A break below 2067 potentially exposes the next intermediate support zone or 2032-2018, which is close to the lower limit of this minor ascending channel, and as well as this graphical congestion zone over here, and slightly above the upward sloping 20-day moving average. But however, if we start to see an hourly close above 2152, then this bullish impulsive up move resume to test the next resistance level at 2200/2210 level. So that's for gold. So lastly, WTI crude. So WTI crude continued to face weakness on last Friday after the uncertainty over that we call it the voluntary extension of the oil supply cut heading into 2024. So what we could see over here is that now prices starts to actually break down much lower below the 74.30 short-term pivotal support that we highlighted on last Friday. But right now it's actually approaching the key medium-term support zone right now, which is this 72.70/72.40 level. So with that, right, I will actually turn neutral for today between 72.70/72.40 and as well as the downward 20-day moving average, which is this level over here at 76.70. Okay, let me highlight again, 76.70. Okay, so neutral between 76.70 and 72.40 for today on the West Texas crude oil. But however, if we start to see an hourly close below 72.40, then potentially it could actually goes down to the next psychological level at 71 figure level for the West Texas oil. So a bit of mixed bag for today for WT West Texas oil. So neutral range between 76.70 and 72.40. So with that, that's pretty much sum up for today's daily dose of market insights. So before we go, any key economic indicator or data to watch out for as for today, European session and US session. So today will be much more a quiet day, except for at 10 p.m. Singapore time, there will be ECB President Lagarde speech. And for US, it's a pretty much quiet session for today. So with that, have a great day ahead and we shall speak again tomorrow. Thank you.